It's January 1980. Silver hits $50 an ounce. Panic spreads through Wall Street like wildfire. The Hunt brothers have cornered nearly half the world's deliverable silver supply, and the entire financial system is teetering on the edge of collapse. Trading halts, emergency meetings. The Federal Reserve steps in, and just like that, the price crashes 80% in a matter of days. Fast forward to 2011. Silver touches $49.80, another violent reversal. History repeating itself. But here's where it gets interesting. As of December 11th, 2025, silver is trading at $60 per ounce. And something very different is happening this time. Something that has Wall Street's risk managers losing sleep. Because the conditions forming right now are not just similar to those historic spikes, they're potentially far more explosive. Right now, we may be watching the start of another cycle. But before we go any further, I'm not a financial advisor, this isn't financial advice, and I'm not connected to anyone mentioned here. I'm simply analyzing public information and drawing conclusions. What you choose to do with it is completely up to you. So why are veteran analysts, some who've been watching precious metals for decades, now openly discussing $250 silver? Why is JPMorgan sitting on what some estimate to be the largest private silver stockpile in history? And why did one of Wall Street's most respected commodities desks recently issue an internal memo calling the current silver market the most dangerous setup we've seen in modern trading? To understand where we're going, we need to understand how we got here. And trust me, this story goes deeper than you think. The infrastructure crisis. Let's start with something most people don't realize. Silver is not just a precious metal anymore. It's a critical industrial commodity that's become essential to the modern world. And we're running out. Here's the data that should concern you. Global silver mine production peaked in 2016 at approximately 900 million ounces. Since then, it's been in structural decline. The Silver Institute's latest reports show production struggling to exceed 840 million ounces annually. Meanwhile, industrial demand alone, not including investment demand, has surged past 600 million ounces per year. Solar panels, electric vehicles, 5G infrastructure, medical devices, water purification. Every single one of these growth industries is silver intensive. A typical solar panel uses about 20 grams of silver. Sounds small, right? But with global solar installations projected to double by 2030, we're talking about an additional 150 million ounces of annual silver demand just from solar. Electric vehicles use nearly twice as much silver as traditional cars, up to 55 grams per vehicle for the electrical connections and components. The International Energy Agency projects 300 million EVs on the road by 2030. Do the math, that's another massive demand surge. But here's the kicker. Unlike gold, which gets recycled at rates above 90%, silver often gets used in such small quantities across so many applications that recycling is economically unviable. It gets consumed, permanently removed from available supply. The Silver Institute estimates only about 15-20% of industrial silver gets recycled. Now layer on the supply side problem. Silver doesn't really have dedicated silver mines anymore. About 70% of silver production is a byproduct of mining other metals like copper, lead, and zinc. When those base metal prices are low, mines shut down or reduce production, and silver supply drops as collateral damage. Several major silver producing regions have seen production fall off a cliff. Peru, the world's second largest producer, has faced declining output due to depleting reserves and environmental restrictions. Mexico's production has plateaued. Even with higher prices, new mines take 7 to 10 years to develop. The Silver Institute's own supply-demand reports have shown deficits for 3 consecutive years. Physical deficits. More silver being consumed than mined. The gap is being filled by above-ground stockpiles, but those stockpiles are finite, and they're shrinking. This is where it gets really interesting. The COMEX, the primary exchange where silver futures trade, has been experiencing something unusual. The amount of physical silver available for delivery has been dropping relative to the number of paper contracts. In 2020, there were roughly 400 ounces of paper silver for every ounce of physical silver in the warehouse. By late 2025, some analysts estimate that ratio has exceeded 500 to 1. What does that mean? It means the market is a powder keg. If even a small percentage of paper silver holders demand physical delivery, the system doesn't have the metal to deliver. The WallStreetBets moment. Remember early 2021? GameStop, AMC. Retail investors discovering they could move markets. Well, they also turned their attention to silver, and what happened next revealed just how fragile the silver market really is. In February 2021, the WallStreetBets community and other retail investors began buying physical silver and SLV shares en masse. The stated goal was simple: expose the paper manipulation and force a short squeeze. Silver jumped from $25 to $30 in a matter of days. Not a massive move compared to what we're discussing, but here's what matters. the physical market nearly broke. Dealers ran out of inventory. Premiums on physical silver coins and bars exploded to $10, $12 over spot price. The U.S. Mint had to ration silver eagles. Refineries were running 24/7 and still couldn't keep up with demand. And this was with silver only reaching $30. Now, here's the crucial part. Investment demand in 2021 was only a fraction of what it could be. The total market value of silver is tiny compared to other asset classes. The entire above-ground silver supply is worth maybe $1.5 trillion at current prices. For context, that's less than 1% of global financial assets. If even a small percentage of institutional money or global wealth decided silver was the place to be, there literally isn't enough physical metal to satisfy that demand at current prices. The price would have to rise dramatically, not as speculation, but as the only mechanism to balance supply and demand. But the 2021 squeeze attempt revealed something else: the concentrated positions in the silver market. A few major banks, particularly JPMorgan, have accumulated enormous physical positions while simultaneously trading the paper market. How enormous? According to reports and research from metals analysts, JPMorgan has been accumulating physical silver since 2011. Some estimates put their holdings at over 1 billion ounces, more silver than many countries have in their strategic reserves. Ted Butler, a silver analyst who's studied the market for 35 years, has documented what he calls the greatest manipulation and price suppression scheme in commodity history. Whether you believe it's manipulation or just smart positioning, the fact remains. A single institution holding that much of a commodity creates an asymmetric market. When they decide to stop suppressing and start releasing, or when the market forces their hand, price discovery could be violent. Here's what keeps risk managers up at night. The silver market has all the ingredients of a black swan event. Low liquidity in physical markets, massive paper leverage, concentrated positions, structural supply deficits, and surging industrial demand. All you need is a catalyst. The monetary angle. Now let's talk about the elephant in the room, the monetary system itself, and why silver suddenly matters again. For most of modern history, silver was money. The words silver and money are the same in at least 14 languages. The US dollar was defined as a specific weight of silver until 1964. Then something changed. Governments realized they could print unlimited paper currency if they broke the link to physical commodities. Since 1971, when Nixon closed the gold window, the world has been on a pure fiat currency system for the first time in history. No gold backing, no silver backing, just faith in governments and central banks. How's that working out? Since 1971, the US dollar has lost over 85% of its purchasing power. The Federal Reserve's balance sheet has exploded from under $100 billion to over $7 trillion M2 money supply. The measure of dollars in circulation has increased more than 30-fold. Here's the critical insight. Throughout history, whenever fiat currencies are debased through money printing, precious metals reassert themselves. Not because of tradition or nostalgia, but because of mathematics. You can print unlimited paper, but you can't print silver or gold. The gold to silver ratio is telling an interesting story right now. Historically, this ratio, how many ounces of silver it takes to buy 1 ounce of gold, has averaged around 40 to 50 over the long term. There have been periods where it has gone to extremes, hitting 90, 100 during times of silver oversupply or gold panic buying. As of late 2025, gold at roughly $2,600 and silver at $60, that ratio is around 43. But here's what matters. In previous bull markets for precious metals, silver dramatically outperforms gold. In the 1970s, gold went from $35 to $850, a 24x increase. Silver went from 1.30 to 50, a 38x increase. Why does silver outperform? Because it has dual demand, monetary and industrial. During times of monetary uncertainty, silver attracts investment demand just like gold, but it also has the industrial demand floor that gold lacks. This creates a feedback loop in bull markets. Central banks are making moves that suggest they see what's coming. In 2025, central banks bought over 1,000 tons of gold for the third consecutive year, the highest sustained buying in decades. They're diversifying away from dollars. China, Russia, India, Turkey, all accumulating gold at unprecedented rates. But here's the thing about central banks and silver. They largely stopped holding silver reserves decades ago. The U.S. strategic silver stockpile, gone, sold off between 2005 and 2015. Most countries have zero silver reserves. So when the monetary reset comes, and history suggests it always does eventually, there's going to be a scramble not just for gold, but for silver as the more affordable monetary metal. Some analysts call silver the poor man's gold. That's not an insult, it's a feature. When gold becomes too expensive for average investors and citizens to accumulate, they turn to silver. At $2,600 per ounce, gold is out of reach for many. At $60, silver is still accessible. But if gold reaches $5,000 or $10,000, what happens to silver demand from people seeking monetary protection? The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working on alternatives to the dollar-dominated system. There's serious discussion of gold-backed digital currencies. If these initiatives gain traction, it wouldn't just affect gold. Silver, as gold's monetary cousin with industrial utility, would likely be pulled into any new monetary framework. The $250 scenario. So let's get to the number everyone's talking about. $250 silver. How do we get there? And more importantly, how do we get there without the financial system collapsing? Actually, that second question might be backwards. Maybe we get there because the financial system is restructuring. Here's scenario 1, the supply shock. Let's say a major silver-producing country faces political instability, or a significant mine faces an environmental disaster. Given how concentrated silver production is, the loss of even 10 to 15% of global supply could create an immediate deficit that can't be filled. Industrial users would panic buy to secure supply. Investors would pile in, seeing the squeeze coming. With the existing leverage in the paper market, prices could spike to clear the market. At 250, we're talking about a 4x move from current levels. Sounds extreme, right? But silver went from $17 to $49 in less than a year during 2010-2011. That was a 3x move, and there was no supply crisis, no structural deficit, just investment demand. Imagine what happens with an actual physical shortage. Scenario 2, the monetary crisis. We've discussed the debt levels, the money printing, the de-dollarization efforts. If confidence in fiat currencies takes a serious hit, whether through a sovereign debt crisis, a major currency devaluation, or a banking system stress event, capital would flee into hard assets. Gold would run first, as it always does, but then, as gold becomes prohibitively expensive and supply tight, silver becomes the overflow valve. If gold reaches $5,000 per ounce, something many gold analysts now consider conservative in a real monetary crisis, the historical gold to silver ratio suggests silver should be somewhere between $100 to $25. But remember, silver outperforms in these scenarios. If the ratio compresses to 21, which has happened before, you're looking at $250 silver. Scenario 3, the green energy acceleration. Governments worldwide have committed trillions to green energy transitions. Solar, wind, EV infrastructure, all silver intensive. If these build-outs accelerate faster than anticipated, or if new technologies increase silver usage per unit, industrial demand could surge beyond even current projections. Here's a data point that should make you think. If the world were to replace just 25% of current energy generation with solar, it would require nearly 85% of current annual silver production just for the solar panels alone. That's not including EVs, 5G, or any other industrial use. The math doesn't work unless prices rise significantly to incentivize more production and more recycling. Scenario 4, the short squeeze. This is the Wall Street nightmare scenario. The concentrated short positions in silver futures, the leverage in the system, the ratio of paper to physical. All it takes is a catalyst that forces delivery demands. Maybe a large fund decides to take delivery. Maybe a country decides to build a strategic silver reserve. Maybe the COMEX simply runs out of deliverable silver in its warehouses. When a market is this leveraged and a squeeze starts, prices don't move linearly. They gap, they spike. Circuit breakers get triggered. In 1980, silver went from $10 to $50 in less than 2 months. That's a 5x move in 8 weeks. A similar percentage move from $60 would take us beyond $300. Now, here's why Wall Street calls this window dangerous. It's not just about price, it's about systemic risk. The major bullion banks have massive derivative positions in silver. When prices move violently, those positions can generate enormous losses. In 1980, the silver spike nearly took down several firms. Today, with much larger positions and more interconnected markets, a similar move could trigger contagion. But here's the paradox. The very suppression that kept prices low has made the eventual move more extreme. It's like holding a spring down for decades. The longer you compress it, the more violent the release. Some analysts argue that controlled ascent to higher prices is actually what the system needs. Allow silver to gradually rise to $100, $150, $200, giving the market time to adjust, incentivizing new production, allowing shorts to cover over time. But markets rarely allow for controlled ascents. More often, they're forced ascents, panicky, disorderly, and shocking. The Contrarian case. Now, let's be intellectually honest here. What are the arguments against $250 silver? Because if we're going to analyze this properly, we need to consider what could go wrong with this thesis. First, technological substitution. If silver prices rise dramatically, industries will innovate around it. They'll find cheaper alternatives. We've already seen this in photography. Silver-based film was replaced by digital. Could solar panels be redesigned to use less silver? Possibly. Copper or aluminum could replace silver in some electrical applications. However, here's the counter. Silver is used specifically because of its unique properties. Highest electrical and thermal conductivity of any metal, superior antibacterial properties, best reflectivity. You can substitute, but usually with performance trade-offs. And when we're talking about critical infrastructure like 5G or electric vehicle safety systems, performance trade-offs aren't easily accepted. Second argument, new supply could come online. Higher prices would make previously uneconomic deposits viable. Recycling would increase dramatically. Primary silver mines could be developed. The counter? Time. Even if silver hits $100 or $150, it takes 7 to 10 years to bring a new mine from discovery to production. Recycling can increase, but remember, most silver is used in such dispersed small quantities that collection is impractical. And primary silver mines are rare. Most silver comes as a byproduct. Third argument, investment demand could evaporate. Maybe the 2021 Reddit squeeze was peak retail interest. Maybe institutions don't care about silver. Maybe digital gold or Bitcoin captures the monetary premium instead of physical metals. Here's the reality check on that. Investment demand is actually just returning. Silver ETF holdings are nowhere near their 2021 peaks. Central banks aren't buying silver, but they are buying gold at record rates, which validates the precious metals thesis. And here's the thing about Bitcoin. It's not an industrial metal. It competes with gold as a monetary asset, but it doesn't power solar panels or electric vehicles. Silver has both lanes. Fourth, the manipulation will continue argument. If powerful interests have suppressed silver prices for decades, why would they stop now? Why wouldn't they just continue to manipulate the market indefinitely? Because physics. You can manipulate paper markets, but you can't manipulate physical supply and demand. Eventually, the physical market revolts against the paper market. It happened in 1980. It happened in 2011. It nearly happened in 2021. The paper market is leverage, and all leverage eventually faces a reckoning. The more dangerous window that Wall Street analysts are discussing is dangerous because silver might go up. It's dangerous because the market structure has become so distorted that when it corrects, it could be disorderly and violent. So here we are. Silver at $60 as of December 11th, 2025. Structural deficits continuing, industrial demand accelerating, paper market leverage at extremes, monetary uncertainty increasing, new technologies demanding more silver, geopolitical tensions rising, de-dollarization progressing. Is $250 silver inevitable? No, nothing in markets is inevitable. But is it possible? Absolutely. And that possibility is being discussed in rooms where it wasn't even on the table 5 years ago. The window Wall Street calls dangerous isn't dangerous because of conspiracy theories or manipulation. It is dangerous because multiple independent variables are aligning in ways that create the potential for a rapid repricing. Supply deficits, monetary debasement, technological demand, market structure, any one of these could drive prices higher. All of them together, history shows us that commodity markets can remain dislocated for long periods, but they always eventually find equilibrium. The question isn't if prices will adjust to reflect supply-demand fundamentals. The question is when and how violently. If you're watching this video, you're probably already interested in these markets. Maybe you hold some silver. Maybe you're considering it. Maybe you're just curious about what could be one of the defining market stories of this decade. Whatever your position, understand this. We're not in normal times. The amount of money printed in the last 4 years exceeds the total printed in the previous century. The debt levels are unprecedented in peacetime. The monetary system is being questioned by major powers, and industrial demand for a critical metal is outstripping supply while above-ground inventories dwindle. Could silver go to $250? That's not the right question anymore. The right question is, what happens to a financial system built on leverage and paper promises when physical reality asserts itself? What happens when the spring that's been compressed for decades is finally released? The window is dangerous, not because of what might happen to silver prices. It's dangerous because of what silver prices reveal about everything else. Keep watching. Keep learning. And whatever you decide to do with this information, make sure you understand both the opportunities and the risks. Because in markets like these, fortunes are made and lost not by those who are right or wrong, but by those who understand what's actually happening. Thanks for watching.